Hello, everyone. My name is Stacey Yamali, and I would like to welcome you to today's webinar, Class Action Risk Mitigation with CFRA's Earnings Scores. Today's session is hosted by Will Sues, CFRA's Head of Quantitative Analysis. Before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. Moving on to the agenda, for today's webinar, I will give a brief introduction on CFRA and how management liability teams use our research. I will then pass the presentation to Will. Will recently conducted a study that tests the predictive value of CFRA's earnings scores to security class actions. This webinar will highlight the results of that study and show that analyzing the accrual component of earnings is critical. About CFRA. This slide shows our history. We were founded in 1994. CFRA's Forensic Accounting Service highlights companies that use complicated accounting tricks to hide operational deterioration. Our analysts are looking at revenues, margins, and non-GAAP metrics and show how these can be flattered through aggressive accounting or other manipulative techniques. We then started Legal Edge in 2006. Our Legal Edge service shows companies that are impacted by litigation. And then in 2016, CFRA acquired S&P Equity and Fund Research. And this fundamental research service complements our legal and accounting-focused research. Moving on to the next slide is our research. We have several different types of research that our insurance clients use. We highlight companies with deep dive analysis. We also have educational research that highlights accounting trends. And lastly, we have bespoke research that insurance clients use for high-risk accounts. Our advisory service is also a key value for our insurance clients. Our clients have access to our industry and accounting experts for one-off questions and custom training sessions. Now I'd like to introduce you to our host, Will Sues. Will is a CFA charter holder and the head of quantitative research for CFRA. Will joined CFRA in April 2018. Prior to joining, Will led quantitative strategy for a registered investment advisor and long-short equity fund. Will?
Thanks, Stacey. Before we discuss CFRA earnings scores in my study, let's have a brief refresher on accrual accounting. Accrual accounting is where both revenues and expenses are recorded when incurred, regardless of when cash is transferred. This means that companies are reporting income in the year when they fulfill the obligations to receive their income. Accrual accounting is extremely useful when studying trends in revenue, expenses, and profitability. Here are a couple big picture concepts to keep in mind. Accrued revenue and expenses are recognized before cash is received or paid. Deferred revenue and expenses are recognized after cash is paid. So to better understand the significance of accrual usage, it's helpful to look at an aggregate trend of total accruals relative to total assets over time. This chart plots the U.S. equity total accruals relative to total assets, the universe median over the past 20 years. A couple points to keep in mind when looking at this chart is that accruals are economically sensitive and increase during expansions and often fall during recessions. Total accruals represent a significant portion of balance sheet total assets over time, with the 20-year median at 54.6%. Now we can shift to a manager perspective on accrual usage. There is a survey done in 2015 of 400 CFOs. 400 CFOs reported that they believe in any given period, 20% of firms intentionally distort their earnings. The magnitude of this distortion is large. The CFOs estimate that on average, 10% of the reported earnings are intentionally distorted. This makes sense when you take into consideration that CFOs are heavily compensated by stock-based compensation. oftentimes they perceive there's benefits of having a premium valuation to peers, again, like I mentioned earlier, higher executive compensation, and even reducing the likelihood of violating lending agreements when refinancing periods come up. So now let's transition to CFRA earnings scores and how we think that CFRA earnings scores is aggressive accounting quantified. So the CFRA earnings scores procedure or methodology is where we measure the non-cash portion of earnings relative to total reported earnings. We then use a proprietary algorithm to compute a relative score where we're comparing each company relative to similar companies in the same region and a similar level of return on capital. Here's how you should interpret these scores. We're first measuring the non-cash component of earnings. It's an estimate of uncollected profit associated with the current period. So high CFRA earnings scores or more aggressive CFRA earnings scores are 8, 9, and 10. These represent large accruals relative to peers, or another way of saying lots of uncollected profit in the current period relative to peers. A few takeaways from our discussion of the overall level of accrual usage and the motivations for using accruals. We learned that managers have very large incentives to report consistent and growing earnings. CFRA earnings scores can identify aggressive accounting assumptions, and aggressive accounting is associated with lower quality reporting and often associated with lower earnings persistence, as pointed out in Sloan's seminal paper in '96 and followed up by Richardson and Sloan in 2005. Lower earnings persistence simply means that given two firms with the same level of profitability, current level of profitability, the firm with higher accruals tends to be less profitable in the future. Security mispricing occurs when investors give the same valuation to one of these companies despite it being less profitable in the future on average. Finally, this connection of security mispricing is associated with elevated class action lawsuit risk. Now that we have a better understanding of the magnitude of accruals and motivations for using accruals, we wanted to ask ourselves the following question. Can CFRA earnings scores help forecast increased risk of class action lawsuits that's applicable to the D&O underwriting window? To try to answer this question, CFRA performed an event study from 2004 to 2018 where we sourced class action lawsuits from Stanford's Securities Class Action Clearing Database, or SCAS. We narrowed the universe of lawsuits to those with publicly traded equity and an available CFRA earnings score corresponding to the month of the filing date for the entity. Finally, we mapped CFRA earnings scores time series to class action lawsuits and aggregated the results. It's most easily visualized in a line chart, and so this line chart represents the mean earnings scores decile at a given point in time prior to the class action lawsuit filing. We feel that the following characteristics from this chart are most worth pointing out. Earnings scores were higher than the median earnings score of 5.5 for the entire measured period, which represents elevated accrual usage. An upward trend occurs 36 months to 15 months prior to the filing date. Finally, we find that in aggregate, earnings scores peaked 15 months prior to the filing date and subsequently trended toward the median of our earnings score universe. Next, in collaboration with CFRA's Legal Edge team of legal analysts, we bifurcated our observations based on whether or not the class action lawsuit was voluntarily dismissed by the plaintiff within 60 days of the date filed. We believe this split is relevant because cases that were voluntarily dismissed quickly might correlate well with class action lawsuit severity. Our study illustrates that CFRA earnings scores for cases that were voluntarily dismissed quickly were significantly lower than those not voluntarily dismissed for the entire period. This could imply a sustained high CFRA earnings score correlates with stronger lawsuits. Our last event study we want to point out is when we split our observations based on whether or not the case was motivated by a merger announcement. We view merger-motivated class action lawsuits as fundamentally different issues compared to those not motivated by mergers. We interpret merger-motivated lawsuits as often a claim that the company failed to disclose significant and material facts that would allow the shareholders to prudently vote in favor of the transaction versus those where the company's core operations just failed to meet investor expectations. We find that non-merger lawsuits on average have higher CFRA earnings scores than their merger counterparts, albeit merger-related class action lawsuits are higher than the CFRA earnings score, the median CFRA earnings score.
Thank you, Will. That is very interesting. Can you summarize the key points from the study?
I'd be happy to. There's 4 key takeaways from our event studies. The first one is CFRA earnings scores exhibit a useful pattern prior to securities class action lawsuits. On average, earnings scores trend higher and peak 15 months prior to the lawsuit filing date. Lawsuits that were voluntarily dismissed exhibited lower earnings scores compared to those not dismissed. And finally, lawsuits motivated by merger announcements scored lower compared to those not motivated by lawsuits, or by mergers, excuse me.
That's very helpful. Can you share some specific examples?
Definitely. We think it's more concrete with a few case studies. Our first case study is Lexmark International. Lexmark is a manufacturer of printers and related supplies, primarily ink cartridges. Lexmark sells its products to wholesale distributors and large retail chains in more than 90 countries around the world. So the shareholders alleged in this class action lawsuit that during the class period in 2014 and 2015, notice on the line chart, it's the period of time marked in light blue. Lexmark touted profitability and growth of its high margin business. However, the defendant or Lexmark failed to disclose deteriorating end user demand where customers purchased inventory to get ahead of price increases. And there is, as a result, excessive inventory levels at its European wholesale distributors. Here's where CFRA earnings scores can help. We believe earnings scores bounced around at normal levels before shooting up to the 10th earnings decile, meaning the danger zone, August of 2015. This was 22 months prior to the filing date, and the earnings score remained elevated for a full 12 months. We think that the management likely realized the end market was in trouble during this period, and management decided to take larger and larger accruals in preparation for its announced strategic alternatives, announced October of 2015. So we try to call out that period of time that they were exploring strategic alternatives. The key takeaway, we believe CFRA earnings scores could have identified aggressive accounting during periods of the end market stress. Another case study is CenturyLink. CenturyLink, believe it or not, in 2013 was the 3rd largest telecommunications company in the United States. Telecommunications simply means that they provided communications and data services to residential, business, governmental, and wholesale customers. Shareholders alleged that CenturyLink made false or misleading statements to investors when they failed to disclose material adverse facts concerning CenturyLink's dividend cut. Specifically, shareholders alleged that CenturyLink misled investors concerning the strength of its franchise, which was the most important factor in the company's ability to maintain its dividend, and we believe the stock was priced based on paying a dividend. CFRA earnings scores can help because we noticed from the line chart that earnings scores were at healthy levels during the first half of 2011. They spiked dramatically August of 2011. This was a full 11 months prior to the class period start of August of 2012. The sharp increase in sustained elevated earnings score could have alerted underwriters that the company was making aggressive accounting choices. Again, the big takeaway here is that CFRA earnings scores could have identified periods of end market stress where the management team was using aggressive accounting. The last case study is slightly different of a use case, but useful nonetheless. Molson Coors is our 3rd case study where Molson Coors manufactures and sells beers and other products. The shareholders alleged that Molson Coors made false or misleading statements when they failed to disclose that Molson Coors did not properly reconcile an outside basis of a deferred tax income liability regarding Molson Coors investment in Miller Coors. Consequently, after not properly reconciling the account, Molson Coors was forced to report net income again for its fiscal years of 2016 and 2017, resulting in a very large downward revision to net income. Here's how CFRA earnings scores can help. Earnings scores jumped from healthy levels to sustained higher levels after Molson acquired the Miller brands from SAB Miller. CFRA earnings scores typically jump in response to very large acquisitions that carry a lot of risk. The key takeaway here is that because all share offerings, financing activities, and M&A activities are the kinds of events that often generate claims, the task of understanding corporate history and structure of the company historically is essential. You could have used CFRA earnings scores to quickly identify not only that there is a transaction, which a lot of different vendors can easily show you, but that it was a very meaningful transaction happened historically. So this would make the task of understanding the corporate history of this company that much easier.
Great, Will. That illustration is helpful. The event study and case studies are showing that the scores are spiking well in advance of the class action to give underwriters time to include the information into their underwriting process.
Thanks, Stacy. That's right. The case studies, if I had to boil it down into two key points, are that there's elevated CFRA earnings scores above the median earnings score for a considerable period of time. The historical line chart of CFRA earnings scores can help underwriters get a quick understanding of the company's accounting practices historically and even the corporate history at just a glance. What you really should look out for is that spikes to the 8th, 9th, or 10th deciles for a series of months tend to indicate either significant acquisitions and an elevated risk of aggressive accounting practices. So this is all interesting from looking at aggregated trends to a handful of case studies, but we wanted to be skeptical of our results in the sense that we wanted to make sure and test our conclusions to see if our results were simply attributable to just pure chance instead of differences in the companies ourselves. The very first step in trying to answer this question quantitatively is just plot the two competing histograms you see here. The companies or the distribution in orange represent the distribution of CFRA earnings scores 15 months prior to class action lawsuits. You should notice a very heavy distribution in our troubled deciles of 8, 9, and 10. They're far above the gray line, which is what we would expect the proportion to be. Compare and contrast that to the histogram on the right, where these companies never faced any class actions throughout our sample period of 2004 through 2018. As expected, we see a very close to a uniform distribution of earnings scores from 1 to 10. So visually, it was very easy to see that the differences appear to be statistically significant. We wanted to further test our conclusions by first running a non-parametric equivalent to an independent samples t-test. It's called a Mann-Whitney U-test. The statistical test is just used to compare the differences between two independent groups when the dependent variable is ordinal and not assumed to be normally distributed. The key takeaway is that there's very little probability that these two groups are the same. We wanted to triangulate our conclusion further by simulating 10,000 random samples from each group. We would take the mean from each group and take the difference. This is just a visual way of viewing the differences in groups when taking a lot of random samples, which you can see on the very next slide. Notice that the histogram of 10,000 samples is nowhere near zero. What this means is that we actually found no examples when we bootstrapped our difference in means that the two populations are the same. This simply means from our histogram to our statistical inference to our bootstrapping mean difference that we find very little evidence that companies facing class action lawsuits have the same distribution. This is another long-winded way of saying we think that CFRA earnings scores are very meaningful in identifying risk associated with class action lawsuits. So to conclude, I'll leave you with a few points. CFRA earnings scores can be related to aggressive accounting decisions. The distribution of earnings scores for companies with class action cases compared to companies who never faced a class action is both statistically and economically significant. Please remember, CFRA earnings scores often peaked 15 months prior to class action lawsuits, with is a useful pattern within the D&O underwriting period. Just to leave you with one quote, the former chairman of Enron, Kenneth Lay, defended Enron as aggressive accounting does not necessarily mean illegal accounting.
Thank you, Will. Before we move on to questions, I'd like to provide some more information on the earnings score as a service. Class action risk mitigation is one example of a use case for our earnings score model. It is also used as an investment tool and for other types of risk mitigation. The model covers roughly 5,500 North American companies and over 27,000 global companies. We deliver the scores on our CFRA research portal and via data feed so that clients can feed the scores directly into their own models. There is a corresponding report available that summarizes Will's findings. Please let us know if you'd like to receive a copy. And at this time, we can take questions. As a reminder, you can submit questions in the chat section of the GoToWebinar. So we have our first question. Does the CFRA earnings score factor in historical class action lawsuits in its methodology?
Thanks, Stacy. That's a great question. The answer is no. We measure variables from the respective company's balance sheet, and we utilize our proprietary algorithm to rank securities similar to other businesses. The key to developing that comp group is that they operate in the same region and have a similar return on capital.
Great, thank you for that. Our second question is, does CFRA consider all 10th decile earnings scores, quote unquote, unhealthy?
This is another interesting question that we get often. Another way to word this is, does the model have any false positives? The answer, or the short answer, is that no, not every earnings score decile 10 is necessarily unhealthy. The reason for that is that companies acquiring another company, oftentimes you'll see an elevated earnings score when the company reports a very high increase in intangibles or goodwill. That's not necessarily to say that the company is unhealthy per se. It just means that the company is taking on quite a bit of risk associated with a large acquisition relative to their own asset base. So we don't view those as necessarily aggressive accounting practices, but rather there is elevated risk, especially from a class action lawsuit perspective, because so many class action lawsuits are motivated by merger announcements.
Great, thank you. If peak score is an indicator of potential future litigation, for example, within the next 15 months, how would a user identify when a score has peaked, which would seemingly be necessary in order to use the score as a predictor of litigation?
Yeah, that's a great question. What I would say to that is that in aggregate, the scores peaked. And what I mean by that is that when we looked at enough examples, we saw that there's obviously a peaking pattern relative to historical trend of that same cohort. On an individual company basis, I think it's easier to use a rule of thumb. If you see for a sustained period of time, I'd say estimate 3 or 4 months at the minimum of anything above an 8, 9, or 10. That's a pretty strong indicator on a company level basis, but our event study looked at the aggregate trend where we found a peak relative to that same cohort historically.
And I'll just add to that, what we tell our underwriting clients is if you do see a trend, I'd say, 2, 3, 4 months in a row of that high score, that's simply an indicator to include in your underwriting process as something you need to take a closer look at. We're certainly not saying that, this is a bad company per se. And our last question is, have you done any analysis of false positives in terms of high earnings scores?
Yeah, I think we answered that a little bit in terms of false positives with respect to acquisitions. The one thing that I would note is that the overall data set that we have in order to analyze false positives is highly unbalanced. All I mean by that is that during the 2004 through 2018 time period, we found 1,800 examples of class action lawsuits. You need to compare this against 27,000 companies that we rate monthly. So even when we try to narrow down that universe and try to parse out where our false positives are coming from, it becomes a little bit more difficult and intractable that the number of false positives is so small to really extrapolate. And we also hypothesize that even though you're not seeing necessarily class action lawsuits for companies with earnings scores of 10, it doesn't mean that they're not pursuing aggressive accounting choices. They're just not getting sued in that particular period. So it's a little bit difficult. We are working towards getting a more concrete answer, but the data set that we have to work with is very unbalanced.
Thank you. Got one more. How does the trend of increasing class action lawsuits over the past 10 years influence your analysis?
It's really interesting because class action lawsuits have grown significantly over the past 10 years. This is primarily a function of the growth in mergers or merger-motivated class action lawsuits, as in our data set, we count that merger-related class action lawsuits were up 11 times in 2018 compared to 2008, an astounding number. We feel like this highlights the usefulness of studying CFRA earnings scores as a first step in the underwriting process, because it's very easy to ascertain a quick flag for the company's corporate history historically, which would apply to mergers of significant size historically. So we still feel like it's valuable, and we feel like a lot of the growth in class action lawsuits has actually been attributable to these types of class actions.
Great, thank you. We got a couple more while you're talking. The next question is coverage solely for public companies, and if so, are there exchange limitations?
That's correct. The coverage is public companies. In terms of exchange limitations, I would say of all the public companies that we source our data from, we don't feel, and I can go back and provide more details for the question asked after the call once I have a more definite answer, but to my knowledge, I believe that we cover companies that report regularly globally. So I don't believe there's any exchange limitations, but I do believe that we do have a limitation for public companies only at this time.
I can confirm that.
Okay.
Yeah.
Thanks. Thanks.
And then the last one is, do these more aggressive accounting practices require disclosure by the company in their filings?
I think the answer is yes, in terms of, so the very first, let me see if I can unpack that question a little bit. The first part is that we can detect aggressive accounting practices from the variables that we collect at a systematic scale, which is what you're seeing in the CFRA earnings scores. The second part is that typically in the footnotes, I would assume that with a longer report like a 10K, you would see more discussion in the footnotes that aggressive or more aggressive accounting choices like different residual values or different depreciation schedules, if they're being used, would be disclosed there. So I think there's two levels of defense. The first one is use the CFRA earnings score to first find the candidates that we think have a high probability of aggressive accounting choices, and then go read the financial statement footnotes.
We also, as part of our qualitative research service, we are identifying companies that are using these techniques to mask problems and deterioration. So we do have that as a source as well. We also do these industry research reports that highlight companies by sector and how they, in each sector, manipulate metrics and what are the common gains and how to look for them. So those are available as well if you'd like to see an example. All right, that's it in terms of questions. On behalf of the CFRA team, I would like to thank you for joining us today. Within the next day, you will receive a note from us with a link to the replay and slides from today's session. In the meantime, should you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. Thank you.